Let's move on then. We have Mithun Aswath joining us, Managing Partner at Kivah Advisors. Mithun, hi, good afternoon. Thanks a lot for joining us. Big outperformance for Indian market, and that continues even on day like today. What are you making of it?
Yeah. Hi, good afternoon. I think, India has been quite resilient in the backdrop of, a lot of inflation and worries on interest rates globally. We've been kind of this market which has stood out, primarily because I think we have a reasonably large domestic economy, and a lot of the sectors which were domestic facing had gone through pressure during COVID, and we're just coming out of COVID, and a lot of these businesses have rebounded quite sharply, especially the discretionary as well as the financial as well as the auto sector. You also have, the open up plays like retail and travel, which have also, rebounded quite smartly. So I think allocations have moved to more domestic-oriented sectors, and that's what kind of helps our market. While, the global-facing sectors obviously have taken a backseat, which includes IT and metals.
All right. Hi, Mithun. Hi, Mithun. Good afternoon. Nigel on this side. Mithun, I think you briefly mentioned IT. The street seems to be shunning it away. It's been the biggest underperformer this year after having a rocking last couple of years. Do you believe the time has come to buy? I mean, in the past, you have said there is value. The last 2 or 3 interactions that we have had. For you now, it must be deep value, right?
Nigel, that's right. I think, honestly, some of the mid-cap IT stocks have not corrected that much. It's been the large-cap, names which you've seen a sharper correction. Some of the niche IT companies on the mid-cap side have stood quite strong even in this market. But we actually do believe some of the other mid-cap stocks, larger mid-cap stocks have also corrected, where, valuations now seem to be quite attractive. There could be, a quarter or two of disappointment, but the runway for these companies, especially on the whole digital and cloud side, is quite large. And I don't think 1 or 2 quarters is going to make this secular story anywhere disappear. So I think investors need to be cognizant of that. About a year back, most of these stocks were trading at, 30-40% higher, and most people on the street were bullish then and talking about the secular story. So I don't think the secular story has changed. It is just that the valuations have come and become more realistic. Obviously, you have a backdrop of slowing growth with the Fed raising rates and the concerns in Europe. But I actually think, some of these companies will see through that. We've seen, wage pressure also maybe peak. Even the Fed, which has raised rates, I think, they are also maybe towards the end of their whole rate hiking cycle.
Mithun, Mithun, you want to name a couple of stocks? You've given us a thesis, and for the last few discussions as well, you've said that yes, you believe that it's the right time to get into IT. Any names that you would like to give us in terms of your preference? Mithun, any IT names you'd like to give us? You're sounding constructive on the sector post this recent correction. Any names could you give us in terms of preference?
Yeah. If you look at this stocks that which are under coverage, on the large cap side, we are playing companies like TCS. While on the mid cap side, we are monitoring stocks like Persistent Systems. That's one stock which we do think looks interesting.
Mithun, for names like TCS, you said TCS as well, right?
That's right.
Yeah, the point is that the base of revenues and numbers is so large, right? I mean, if you're on the top of the food chain, to do anything very outsized in terms of growth rates becomes harder, isn't it? But the question I'm getting to is, will the same set of stocks, the big ones, TCS, Infosys, etc., do well when the cycle turns? Or at least the market looks at the IT sector favorably, or it perhaps will be a newer set?
Prashant, I think, the large cap stocks obviously provide you solidity. They are not going to give you, the 20% CAGR. They would be more the 12 to 15% CAGR type of companies. But when you're getting them at the lower end of the spectrum, I think it is a good opportunity to invest. But I think some of these mid-cap companies that I was talking about could potentially grow earnings maybe 25% over the next 3 or 4 years. Maybe 1 or 2 quarters would be bad. But if you were to look out 3, 4 years from now, if these companies could double their revenues, it wouldn't really matter. The 1 or 2 quarter performance would not matter.
All right. Final question then, Mithun. Before we let you go, I believe the stock you're looking at is Eveready. We have a change in the promoter entity. Business could look up from here. Input costs have cooled down for them. I think zinc would be a big component in terms of their raw material cost. You believe at around 330 rupees, the stock is looking up?
Yeah, Nigel. I think, Eveready is one of those stories where, solid brand, they have over 4 million touch points across the country. And with the change in management, I think there's going to be a lot more focus on growing the existing businesses of batteries and torchlight. And the big business driver will be for lighting. That is an opportunity that they see where they will grow quite aggressively. They're looking to grow the lighting business to about 500 crores over the next 2 to 3 years using the current distribution network that they have. I also do think that the margins may have kind of bottomed at the current levels. And there also you will see sort of, upside. I think this is a good consumer play where, downside is limited because the recent open offer price from, the Berman's was at around 320 rupees. So there's limited downside. And I think this is a good way to play on the consumption side.
All right. We will leave it there today. Mithun, thanks a lot for joining us.